Hey everybody, I hope you're doing good. Today we are back with a new update of my dividend growth portfolio. It is coming along really nicely and I've actually hit a major new personal milestone. The issue is that this milestone is now creating some problems for me. Talk about suffering from success. I'm not exactly sure how I'm going to solve them, but I have a few ideas. Before we get into that, let's take a look at how my portfolio is currently doing. If you want to take a closer look yourself, you can find the link to my dividend portfolio in the comments and description below. The last time I shared my portfolio on the channel, it was worth about $16,400 US. Today, it stands at just over $17,133. In the last few weeks, I've added about 750 British pounds. This was partially cancelled out by a $350 drop in the value of my holdings. As of now, my capital loss stands at $1,798. There are two reasons behind that. The first one is my biggest positions took a hit, but the other reason is actually related to exchange rates. We're gonna look at that in a second, but first, some happy news. I have officially hit £1,000 in annual dividends. Last month, my dividend yield was only $1,086. But today, my dividend yield stands at a whopping $1,268 or £1,015. Even my dividend growth rate has gone up from 8.3% to 8.6%. It doesn't get much better than that. Months like these feel really good and I'm pretty happy with how August has turned out. It's not great to see the $350 capital loss, don't get me wrong, but over the long run, the dividends are gonna outweigh this by a lot more. It can take years to get your dividend snowball, so you have to stay patient. The only problem is that I'm not very patient, and I think most of you can relate to that. A good way to address that is by tracking your dividends. So let's take a look at what dividends I got paid in August. Now, August was not my biggest month. May and June are actually my peak months, but August was pretty solid regardless. I got paid $124 in dividends, roughly equal to £100 for everyone in the UK. The biggest payout was by Arbor Realty Trust, totaling $88.36, followed by AG&C with $27.08. I had a bunch of other smaller payments. 91 PLC paid me 3.35 British pounds. Realty Income paid me $1.3 and Unilever paid me 1.1 British pounds, and there was 3 other tiny dividend payments. Overall, $124 is pretty solid. That's my gym and jiu-jitsu paid for, so I'm a happy camper. Plus, $124 is more than double from the $57 I got paid last August. Dividend growth is the name of the game, guys. That's the plan and we have been executing well. Fingers crossed, I'll be hitting $200 next August. Dividends aside, let's look at my portfolio performance. It's safe to say this was not the best month for my dividend portfolio. The S&P 500 did about 2.5% better than my portfolio, and the FTSE Global did 1.4% better. It's not a big difference, but my portfolio is still underperforming. Now, it's not unusual to see that. The important thing is how your portfolio does over the long term, so a single month of being down is nothing to worry about. Still, let's take a closer look at why this happened. Like I said at the start, my dividend portfolio had capital losses of $350. 3 of my biggest positions went down over the last month. Lego in general, Persimmon, and Enphase were down a combined $454. AG&C and Arbor Realty Trust were also down $47 each. A few other stocks dropped as well. These were partially offset by Direct Line Insurance Group and IIPR, which went up a combined $277. The reason why Lego in general was down is because of interest rates. Higher interest rates mean that the fair value of the assets under management dropped by 10%. Even though their operations actually did well, the share price went down. Plus, they had their ex-dividend date, and stocks usually dip when that happens. Higher interest rates are also affecting home prices and home demand, so Persimmon took a hit too. Arbor Realty Trust, AG&C, they are mortgage rates, so they took a hit because the Federal Reserve signaled that they are open to more interest rates. The markets previously expected a peak of 5.5%, but now it looks like we may see 5.75%, maybe even 6%, even though that's very unlikely. Basically, this was not great, but the drop is not sustained in my opinion, so I'm not too worried. The silver lining here is I can grab some of these stocks at a cheaper price. That's what I did. I sold the dip, I bought the dip. Fingers crossed, these stocks are not gonna keep dipping. The other reason why my portfolio value is down are exchange rates. The GBP USD rate went down from about 1.277 on 10th of August to 1.2469, which is a 2.2% difference. You're probably thinking 2.2% is not a lot. That's sort of true, yes, but 45.8% of my portfolio is in UK stocks, traded in British pounds. This is a very rough calculation, but the dollar value of my portfolio is down by about $175 because of that. It doesn't look great on paper, but I live in the UK, so in reality, nothing has changed for me. An actual, bigger problem that I'm now facing is taxes. Hitting £1,000 in dividends is awesome, but the problem is I'm now above the dividend allowance for the UK. Last year it was £2,000, this year it went down to £1,000 and it will shrink even lower to £500 next year. A 33.75% tax has to be paid on any dividend above that allowance. That's not great. On the bright side, I don't think I'll go above the threshold for this financial year. Next year though, that's a different story. My dividends may get taxed a lot. I'm already paying a 15% withholding tax on US dividends, add another 33.75% on top of that, and it makes no sense for me to buy more US stocks. The good thing is there is a way to work around that, and that's by using a stocks and shares ISA. I already have a passive investing ISA with Moneybox, so I need to wait until next April to open a new one. This means I have to scale back on my monthly buys for the time being. The other option is to just shuffle my positions a bit, get some companies with higher, more reliable dividend growth but lower yield, maybe in different sectors. I am overexposed to real estate and financials, so I want to do that anyway. Most of my dividends come from 3 companies in the real estate and financial sector. Arbor, AG&C and Lego in general make up 67% of my dividends. That's way too concentrated and I need to spread the risk a bit. That's what I've done with my latest purchases. I've been buying more consumer staple companies like Target, Altria, Kroger. I bought some Realty Income, Johnson & Johnson and also some Rio Tinto for some exposure to the base materials sector. Target and Realty Income are actually at a great price right now and I've made videos about why I think so. Overall, my dividend portfolio is chugging along nicely. It could be doing a bit better, yes. However, the dividend is growing steadily, I'm reducing my risk by diversifying my holdings, and I'm trying to focus on the long term. How is your dividend portfolio doing? Let me know in the comments below, and please leave a like if you enjoyed this video. Thank you, and I'll see you again in the next one.